manager for the public equity asset class here at ASRS. So if we could turn to page 56 of 304, please. And again, anytime during this presentation, please feel free to stop me if there's any questions at all. So thank you. Okay, so here we present our performance as of December 31st. So total public equity there is in the top table, and we break this down into US and international equities in the subsequent two tables there. So regarding total public equity, we continue to compound strong gains for the asset class. Now, despite some exorbitant volatility throughout 2025, we still posted a total return of 22% for the calendar year. And if we look to our longer term returns, namely the 5-year, 10-year, and since inception, they're all well above the 7% required rate of return for total plan, which we're very proud of. If we turn to excess returns for a moment, again, here we continue to compound the strong relative outperformance. So as a reminder for the committee, we take very little active risk in our portfolios, what we refer to as tracking error, and we work to compound these small but positive excess returns. So we are well on track to achieve our target of outperformance of 25 basis points this fiscal year. And we have actually done this over the last 5 years consecutively. Now, for some perspective, 25 basis points of outperformance in this asset class equates to about $70 million in value add above the benchmark in a fiscal year if achieved. So we dig into US versus international performance here. We can see along the longer term trailing periods that US equities have really outperformed international equities. However, international equities did have quite a stellar 2025, beating US equities by a wide margin for the first time in several years. Now, this is driven by a weaker dollar, but also as investors shifted internationally to stronger local market returns. If there's no questions on performance, I'll move on to page 58 of 304, please. I think we have a different page number. Sorry about that. All right, so here I have some basic asset class statistics to go over. So on the top left, we can see that we are still the largest the largest asset class within total plan, sitting just shy of 29 billion as of December 31st. Now, 65% of the asset class is managed internally, with the other 35% being managed externally by indexers like ourselves. In the top right, we see that we are in line with our benchmark, both in terms of region and size, with no active tilts to speak of. And these bottom two charts have not really changed over prior quarters. The sector weights and top 10 portfolio holdings pretty much remain the same as in prior quarters. We've had our discussions here. No questions here. I will move on to house views, please. I have page 60 on mine. Sure. So I will start here by saying the world can change fast. We developed these house views in January for the year, with some refinement in early February, but all well before the war started. So at the start of the year, markets were discounting a mostly strong 2026 due to early tailwinds from both monetary and fiscal policy. So some positives do still exist, such as larger consumer tax returns and deregulation efforts, but the earnings and growth narrative is increasingly becoming less enthusiastic. We can go to the next slide, please. So here is the first time we've done this for our house views, but what we've done here is assign probabilities to how we think the S&P could finish the year. So again, at the start of the year, we're expecting modest returns, and then we put a 40% probability that we end about 7,200, which again would have been a modest single-digit return for the calendar year. However, in recent weeks, most of these categories have shifted to the left into a more bearish stance. So the geopolitical situation can be resolved sooner rather than later. Perhaps most of the economic damage can be contained. But of course, this is the biggest risk that we are monitoring at the moment. And now subsequent slides do go over the earnings growth that was expected this year. However, we will need to wait till we get earnings calls starting next month to get more insights on how this is affecting companies and earnings. And further, we'll need to get more insights over the subsequent quarters as well. And then as going into 2026, valuations, we measure these primarily by the forward price to earnings ratio, were already stretched in both the US and international markets. So what we've discussed here, when these rich valuations can do is make the market much more sensitive to risk-off events, which is something we saw throughout 2025 and already this year alone being down just about 5% currently on the S&P. Now, but going forward, we will continue to monitor both the absolute and relative level of equity fundamentals, and we will position ourselves accordingly. Given that things have changed so much, I don't plan on going into all the subsequent slides with all the details regarding the earnings and valuations. So I will conclude here unless there are any further questions.
Mr. Chair, may I ask a question?
Yes, absolutely, Tom.
So I noticed that a lot of the material here on the public equities was talking about 26 or 27 earnings, etc. So it we're pretty much benchmarked on international versus domestic, and then size, those different dimensions. I'd be interested to know what would cause you to come to a meeting and say, we think we should deviate from these for reasons X, Y, or Z. I suspect the underlying reasons, given the nature of our liabilities, is probably longer term than next year or the year after. So I just want to make the point that going forward, maybe talking about what those decision points might be for this house, and if we might have a little bit commentary on those points, looking maybe longer term.
Absolutely.
That might be a fun session to do at some point in time.
Absolutely. We'll take note of that. Absolutely. And to answer the question just in the moment, really we are trying to track the benchmarks as closely as possible. So within the public equity asset class within it, we don't take too many tilts away from benchmarks, again, in terms of region and size. Most of what we do is we call the selection effect. So within these regions, within these size, we're trying to take security selection effects versus the overall allocation effect. So nonetheless, going forward, we'll absolutely provide some commentary. If we were to make a big change to allocation, we'll have some commentary going forward. What would change our minds? Because it would be a big shift for us. So we'll absolutely have some commentary.
My guess, based on history, is that you'd probably have to see something pretty profound to.
Absolutely. And there's been a lot of profound events these last 2 years, but it would be very profound, like you said.
Be helpful to know what it would be that you'd be looking for in those regards.
Absolutely.
Yeah. Great.
Thank you.
Thanks, Cole. John?
Thank you, Cole. Thank you, Mike. My name is John Truziak, Portfolio Manager for Credit Fixed Income. Hello to all today. Thank you for the time. We can start on page 70, please. Thank you. So I'd like to direct everybody listening to the top of this page, looking at the overall returns for the interest rate sensitive asset class as of 12/31. A couple things to point out is the continued outperformance of this asset class, and that is coming from active management with regards to where we tilt the portfolio with regards to duration, and then some securities lending income, as well as non-index securities that we are allowed to invest in as part of the tracking error that this asset class is allocated. So you can see over the 1 year, 3 year, 5 year periods, there is continued outperformance. Even checking today, we have had a very good March, and that's just due to where we were with regards to duration versus the benchmark, as rates this month have increasingly increased since I put this presentation together. And then a couple of other call outs I want to make on this page is the bottom left pie chart. Typically, this pie chart had read around 97% internally managed, 3% externally managed for this asset class. Over the course of the 12/31 quarter, we reweighted this asset class, moving it back to the current allocation of 6% as it calls within the strategic asset allocation. So when we moved capital back into this asset class, not only did it go into the external account, which is managed by an external third party, but also some of those dollars flowed into the interest rate, the internally managed account, which we manage internally. Now, the reasons for giving some of it to an external manager included economic fee breaks once you reach a certain threshold that's in that. So we're taking advantage of those, as well as just getting it back to the SAA of 6% for this asset class. Next page, please. And this really sums up the amount of dollars that was moved into this asset class. If you look at the top, the net asset value versus the prior quarter for amount of dollars that came back into interest rate sensitive to get us back to that 6% strategic asset allocation weight. So we moved quite a few billions of dollars, or 1.6 billion roughly, into the asset class. Like I said, some of it into the externally managed accounts, some of it into the internally managed account. And the bottom left page of this page, kind of funny, as I was checking this morning, like I said, March with the war and what rates have done since I put this presentation together, the current yield to maturity of our benchmark is 4.17%. So from March 2025 on to the end of last year, rates had continued to come down. When I put this, like I said, presentation together, I'd even wrote on a House Views page that rates are near 12-month lows. That is not the case today. There's been a lot, as Cole mentioned, happening within the equity and interest rate sensitive markets, and I'll touch on all that on the House Views. But I just wanted to really point out, because when I was looking at this chart, when I put it together a couple of weeks back, I was going to explicitly mention the downward trend of interest rates on our benchmark, and that is not the case as of today. I'll stop there with any questions.
Any questions from anyone on the committee? Hearing none, please proceed.
Thank you. I'll move on to page 73, please. So overall, for the interest rate sensitive asset class, we are very, it was a House view to get it back to its 6% target allocation to match the strategic asset allocation. We continue to outperform. Like I mentioned, the year-to-date fiscal year for 12/31 had 14 bips of outperformance. The 1 year, 22 basis points. Checking today, we continue to outperform for this kind of from January 1 to today. So we're really excited about how we've been managing this asset class internally to continue that outperformance. Like I mentioned, that's just due to some non-index security selection, as well as views on how to weight the asset class with regards to duration, as well as security lending income. And then the bottom two bullet points, like I said, it was very funny when I put this presentation together 3 weeks ago. You can basically just scribble out what I wrote for these House Views. The world has changed in those 3 weeks. Interest rates have changed dramatically within those 3 weeks. They have continued to escalate. The federal funds rate market is pricing in actually a better chance of an increase versus decreases, which, like I said, 3 weeks ago, that is not what the prediction market were kind of predicting, and the futures market penciling in. So that is our job to, track what's going on daily, position the portfolio, and work with our colleagues to best position it based on what's going on every 24 hours, what our future views are, and best position it to outperform and think with a total fund hat to do what's best for the total fund. And with that, thank you for the time, and open to any questions. And if not, thank you.
Any questions? Okay. Next up.
Thanks, John. Next, we'll go to Samer, and then Mike Copeland for real estate, and then wrapping it up would be Al for credit.
Good morning, Mr. Chair and members of the committee. For the record, my name is Samer Gaddar. I have a weird voice. I recovered from a sickness last week. If we can move to page 78, if you don't mind. I'm not gonna be repetitive on performance, but if we look at the performance for private equity for the last 3 months and the 1 year, you can see that there is on the 3-month outperformance on IRR basis by around 90 basis points, 90 plus, and on TWRs on 43 basis points. We do expect it to stay this way, slightly over. And if we move to page 79, we will talk later about the benchmarks, but this is a good graph about that presents public market equivalent, meaning dollar for dollar, cash for cash investment compared to if we did the same with the public markets on the MSCI global benchmark, which is all country index. You can see that our outperformance is around 0.25 times or 0.3 times. That means the dollars we're investing in private equity are outperforming on cash basis the public equity benchmarks. If we move to page 80, this slide, I thank our colleague Andrew who did it. It just shows what we did in terms of portfolio construction, I would say starting 2018-19. You can see prior to that, our primarily decision in private equity was how does a manager or a fund or a strategy compares to public markets. We turned around this story, we restructured how we do things and so on. We've spoken about this in multiple committees. And we have different underwriting, and you can see that changed. And now our second quartile and first quartile are in the top. So if you compare the performance per vintage year, you can see there's more second quartile and first quartile. And this is very important because the difference between first quartile and fourth quartile is 20%. So if you look at the fourth quartile returns in the industry, it's around probably 3.5 to 4%, while first quartile is post 24%. So yes.
Samer, if you could just summarize in bullet points, what were the big, 1, 3, 5 big changes between these two regimes?
Sure. So looking at the portfolio constructions from, I will compare it to the following. Imagine you have a room and filling it with boxes. We were filling the room with boxes without understanding, and this is not, I'm not being critical, without understanding how this room will shape up afterwards. Now we look at the shape. That means we look at the sector comparison. What do we have in terms of exposure? What type of performance going forward? What type of performance in terms of, is this manager consistent? Because in private equity, unlike public equity, when a manager outperform, they do outperform in the future. In public equity, the majority of managers, when they outperform, go sell them or cash out because they will underperform in the future, because that's the nature of the biases. With private equity, they get better at it. So we decided to structure the portfolio, first of all, to look, to take the benchmark of what's in the public equity, in private equity in terms of sector exposure. How does it look across the vintage? How do we reconstruct it as well in terms of lowering fees with the co-investment program and get a higher way of selection or a better way of selection in the underlying? And that will naturally create a portfolio, first of all, that will have the beta of the market of private equity. However, it is how to outperform the beta of the market. So we have analytics we've never used. We have a private company that does analytics. It's based out of France for underwriting. We do a deep dive into our own due diligence, and our memos are sometimes 18, 20 pages. That's different from the consultant's memo. And we don't take it for granted that any manager we're in is going to re-up. Lastly, I would say we had a wide spectrum of the number of funds. So total funds, including the ones that we got the cash back, are around 230, and that's like 96 managers. So we took the number of managers and placed them in tier 1 managers, tier 2, tier 3. Tier 3 are out of selection. Tier 2, we look at them, but not necessarily. And tier 1, we'll make sure the number will be at 40. And the tier 1 that's currently in our portfolio is around 35. So we decided we need to increase those number of managers to 40. And we consistently look after what's going on in the portfolio, and we have the systems to look for. So we have eFront, and we have another module of eFront called Insight. So we have a see-through of our underlying, which I have two slides about it later.
Thank you.
If we move to slide 82.
Sorry, I was on mute. Samar, before you move off that slide, can we go back to that slide? I've got just a couple of quick questions.
Yeah, I did expect to get a lot of questions on that slide, so that's a positive thing, definitely.
Yeah, no. First, the performance looks good. I just want to make sure I understand. So this chart reflects for each, it's the capital contributed by vintage year or the capital committed by vintage year? Is it, I'm trying to understand, each.
It's the fund commitment
Yep.
by vintage. So we take the universe of Cambridge
Yep.
for every vintage, and
Yep.
we compare with the funds that are in that vintage that we committed to.
I got it. So in 2024, for example, we've got, DPI of 0.04. So basically we've got very little capital returned, but has it all been called? For
2024 is usually because it's 1 year, so it's like if you compare it to commitment. No,
Yeah.
but, in 2024 we had a lot of continuation vehicles that were offered to us.
Yeah.
A lot of them were cashed out, knowing that they came to us at a good valuation and it's a good time to exit. A lot of them came at a discount. We knew that the discount was excessive, so we rolled. So a quarter after the performance was picked up, so they increased the performance by 2 times. So that's why you see like a huge outperformance. On DPI, that's mainly it, I would say. The continuation vehicles distributions, because usually in 1 year you don't get distributions.
Yeah,
So naturally the DPI becomes high.
That's what I was trying to reconcile. So the 1.2 multiple the TVPI versus the 37.4% net IRR suggests that you were probably back end in the year of 24 with the capital that flowed out, and then a
Yes.
big mark at year end, right?
Yes, correct.
Okay.
Correct, because you when you do a continuation vehicle, you exit one fund at X valuation.
Yeah.
And you come to the new fund, which is a new one asset fund, and the quarter after it picks up in valuation goes to the year. So the 0.2 times in TVPI will shoot up your IRRs.
Okay, got it. Thank you. That was helpful.
Of course. If we move, I promise to be at 8 minutes, so I'm gonna rush through this.
We're fine on time.
So if we move to page 82, if you don't mind, that's generally the cash flows. The cash flows for private equity are, I would say, even. That 2025 we're short of $300 plus million. That's purposely done to increase our commitment to the co-investment program. If we exclude that, it will be distributions equals capital calls. So it's purposely done. I will move now to portfolio exposure, which is on page 85. So we always speak about it. This is one point even to the prior question. One of the things as well, when we allocate, I didn't mention it before, we do look into the performance of the underlying exposure in terms of subsector. So are we in the right spot? Meaning, do we have large cap? Do we want to be in mega cap? Do we want to be in micro cap, and so on? So we decided a couple of years ago, we want to be in the mid market and the lower mid market, sometimes the upper mid market, which falls like large cap. If you look at the percentages, 37% of NAV now is in mid market. That was probably half a couple of years ago. So we know that large fund and mega fund have the returns will go down naturally because the size become too big. There's limited deals, there's limited exits, and so on and so forth. And if you look at the uncalled capital, which is capital that we committed but it's not, it goes to 48%. So this is where the outperformance of the mid cap is naturally higher than the large cap. So that's another selection of way we look at the portfolio. And as well, the one point as well to notice here is the co-investment program. It's currently off NAV is 13%. Uncommitted is almost 20%. And we're approaching the target. Our initial target was to reach 30% by 2028. I think we're gonna be earlier than 2028, and that's predominantly because of performance. I'm gonna go now to views. So I will go to slide 90. I spoke about this earlier, which is how do we select? We select the sector specialists. We don't go to generalists. And then it is proved throughout history that sector specialists outperform. If there is no specialist in any strategy we want, we would go to a multi sector. However, they would have the right team for each sector. We do not we go through is there any financial engineering? We make sure that the returns are excluded from financial engineering, and we focus on operational value add. Geographical approach is mainly predominantly the US and Western Europe, split between, I would say, in NAV 2080. 80 means the US, 20% Western Europe. Western Europe includes the United Kingdom. How did the performance of private equity, how was it in 2025? We had way better performance than the years from 23 onwards. Exits were expected to be higher, however, because of the tariff issue that happened in April, a lot of deals were pushed to the summer, and usually summer is not active. But we did end up with a total exits of aggregate exits of $620 billion for the industry, compared to 379 for 2024. IPO activity as well picked up in Q4. We were expecting IPO activity to be much better this year, but the war now delayed a lot of deals because the market volatility doesn't help IPOs. If we go to slide 94, this is on secondaries. 94, it's on my deck, so probably the slide before that, 2 slides before that. Secondaries were at all-time high. When we mean by secondaries, meaning especially the single asset continuation vehicle or the portfolio continuation vehicle, they were approximately 10% of the exits. We do see them to stabilize at the 10-12%. And now there's a lot of funds that are coming to market that are just secondaries markets, so there's a lot of capital. In total, there were 133 continuation vehicles until October. Probably they finished at 145, and that's why we did notice this segment of activity, and we knew that it's here to stay. We took advantage of that, and we started an SMA that just invests in secondaries, and we committed 2025 $250 million to that SMA.
Can I ask a quick question? So when
Sure. Yes.
you're looking at secondaries, in our process, do we actually look at the underlying holdings in detail?
Yes.
Somebody does that?
So there's two type of secondaries. The one that are offered for us from our GPs.
Mhm.
So we have our own deep look. Of course, we study the model, the performance, the expectations, the underwriting, and so on, and we decide accordingly. We bring it to the investment committee, the staff, CAC, for decision making. When it comes to the separate managed account, it is predominantly the manager, because we don't dedicate any of our GPs to them. In the co-investment program, 60% of the co-investments come from ASRS, 40% from the GP. With the secondaries, it's all the manager. Sometimes they do. It's natural to have some deals that we see that they probably see, but it's what we have in common, probably 10% of GPs, so they don't see what we see. And I would say 80% of our secondaries offered to us, we usually decide to cash out because of the underwriting and the go-forward returns. I will move now to the pacing model, and that, yes, I'm almost crossing my time. On the pacing model, that's in slide 97. Okay, so we work with the pacing model with our consultant. It takes us 2 to 3 months to come up with the number that looks at the industry, our portfolio, expected returns of the portfolio, expected returns of the total fund, net performance, and so on. This year, 2026, the committee approved up to $1.5 billion, assuming that distributions to net asset value would go up to 15%. Last year, it was 13%. If that doesn't come true, it doesn't mean that we will be committing the $1.5 billion. It will be dependent on how to keep the ratio of the private equity to total fund at 13%. I conclude here, and I'm happy to take any questions. Sorry, it was marathonic, but I tried to cover everything in a couple of minutes. Perfect. Thanks for listening.
Thank
Hearing no
you.
questions, move on to Mike Copeland for real estate, please.
Thanks, Mike. Good morning, Chairman Pitkinis and members of the board. For the
Morning,
record,
Mike.
my name is Mike Copeland, I'm Senior Portfolio Manager of Private Markets. If you could turn to page 103. As of yesterday, the allocation of real estate relative to total fund is at its target. It's 15.2% versus the 15% target. For the 1 year performance, I'll note that on the short term, we're underperforming on fiscal year to date basis. But there is a delay in reporting for 12/31 due to the audit periods, as all of our separate accounts, which is 80+% of our real estate portfolio, have delayed reporting, and so we've only received 20% of the NAV. Based on appraisals and markup and valuations, especially in data centers, as well as industrial portfolio, we expect that by the end of the fiscal year, we will either meet the benchmark or slightly exceed it.
Hey, Mike, quick question for you. So given that you didn't get the audited or the results from the sponsors, what are you carrying in the value? Just you carrying it at cost or the last quarter's mark to arrive at our performance?
So the time-weighted returns reflected here are as of 12/31 is 9/30 asset values plus cash flows received during the fourth quarter. The fiscal year-to-date return that's in the daily asset allocation is 9/30 valuations plus cash flows, with the exception of about 20% of the NAV of the portfolio. We've received $2.2 billion of NAV for 12/31 numbers.
I got it. But you're using 9/30 marks for wherever you don't have, for the 80% that you don't have, you're using 9/30 marks. Got it. Thanks.
Correct. Yeah. I'm going to, given time constraints, I'm going to turn it over to Taylor and Cindy from RFA to present the implementation plan. I'll just note one of the big changes relative to last year's implementation plan is hold period, as we consistently want to incrementally improve performance and continue to outperform the benchmark. Historically, our hold periods for assets were 7 years plus. So over the next 3 years, we expect to sell a significant portion of assets within the separate account portfolio, and then recycle that capital into mostly existing managers with a couple of new opportunities that we're evaluating. And with that, I'll turn it over to Taylor and Cindy.
Great. Thank you very much, Mike. And just confirming that everyone can hear me. Great. Thank you. If you wouldn't mind jumping to page 117, which is a good summary, though text heavy, of the pacing plan. Bottom line is that with the current allocation now at, or as of today, actually a little below the target 15%, the pacing plan reemphasizes building up new commitments, building up commitments to both new and existing partners. Specifically, we're pacing $1.3 billion to existing partners and $1 billion to new strategies over the next 5 years. This is against forecasted $760 million in distributions in calendar year 2026. mostly from disposition of non-strategic or peak value properties. Given the focus over the past 3 years on shifting the real estate portfolio toward the current target allocation, we are recommending a ramp up in new commitments in order to prevent potentially meaningful underallocation given the number of liquidity levers that have been pulled, and take advantage of expected recovery of real estate performance as both discount rates seem to have topped out and fundamentals are improving as supply gets absorbed in many, if not most, markets. The emphasis for new commitments is on value creation, which for ASRS primarily means buying assets below replacement cost, leasing vacant space, and eventually more capital expenditures through asset repositioning and development. We continue to recommend investing primarily alongside long-term demand drivers that steers the portfolio toward in the direction of residential and logistics, though we think office may have been oversold and offers interesting investment opportunities. And ASRS has an advantage of having relatively limited office in its portfolio, and so therefore relatively limited problems that it has to deal with before embarking on new office investments. The last thing I'll note on this page is that ASRS's direct approach to real estate has enabled it to respond effectively to both the changes in the strategic asset allocation and market opportunities. And in other words, it's been enormously helpful during the past few years, during the downturn, to be able to generate liquidity where possible, and should be very helpful on the upswing to be able to take advantage of new opportunities as well. In the interest of time, I'd love for you to skip to page 119, which demonstrates the outputs of the, maybe let's go to the next page, actually, 120, which is a graphical illustration of this. Again, this reflects new commitments to both existing and new partners, with investments taking place over the next 2 to 3 years and winding down of existing strategies. Key takeaways on this slide include compliance with the target allocation, and as we're at the target allocation today, meaningfully more distributions than contributions from the real estate portfolio, 4.3 billion over this period in forecasted net distributions to the broader fund. If we can go to the next page, just to emphasize the last point, Mike Copeland mentioned a mature allocation requires very active portfolio management. We have always focused on proactive asset management oversight, with one of our most important tasks in collaboration with ASRS being annual, at minimum annual, hold-sell analyses for every property. But based upon both academic research as well as our own observations within the existing portfolio, we'll likely be pursuing more active recycling than we've seen, especially relative to the period in which we were trying to grow into the allocation. So with that, I'll hand this over to Cindy to emphasize the strategies we'll be focusing on ASRS's behalf.
Great. Thanks, Taylor. Hello, everyone. Cindy Thomas with RCLCO Fund Advisors. If you can move to page 122, please. So as mentioned, the real estate portfolio is heavily allocated to separately managed accounts, which now represent predominantly 9 core partners focused on those strategies with strong long-term demand drivers, while also providing the desired property type and life cycle geographic diversification identified within the model allocation. As Taylor mentioned, the bias really is towards those strategies that support housing and industrial, followed really by data centers because of the outside valuations that we're seeing in that sector today. If you can move to page 123, please. So now that the target allocation is met, the goal really is to maintain that allocation over the long term. And ASRS is in a position to evaluate new commitments over this forecast period, really with the majority of those commitments targeted toward existing partners. So also, as you've heard, key to this implementation plan is really a theme of active portfolio management. So we're taking a top-down look at investments going forward, as well as a bottom-up in terms of what exists in the portfolio today. From a macro perspective, improvements in capital markets and really real estate fundamentals create conditions for an active time to be investing new dollars. And then, as said, within the current portfolio, a real disciplined evaluation of the continued investment potential at the asset level allows ASRS to be a more regular seller for recycling of that existing capital into higher conviction opportunities. Importantly, ASRS really has moved over the years toward an investment vehicle model that allows for direct approval of new allocations and governance over that investment activity and sale activity, which will really be apparent over this forecast period. If you can move toward the next page, please.
Cindy, this is
Yeah.
Jake. Could I ask you one question or a couple
Sure.
questions? First, I noticed on the recommendations for 26, the prior slide showed that we had an allocation to build to rent, and is the kind of forthcoming housing bill and the implications on build to rent impacting the lack of recommendation for continuing on that BTR side for 2026?
Yeah, I'm happy to take that. The answer is yes. We are taking a wait and see approach to see how the legislation proceeds, specifically the surprise clause in the Senate bill that required disposition after 7 years.
Yeah.
So yeah,
I
fortunately, yeah,
doubt that's going to survive ultimately, but it's, who knows, right?
we're trying to be prudent ultimately.
Sure.
And in this environment, who knows exactly?
And then I had one other question, which is, I noticed a couple of fund investments here. So a multifamily, small $50 million seed investment in a multifamily development fund, and then an industrial value add fund. So that's, small relative to our SMA commitment, the commitments you're recommending here. But I have a question specifically to the I guess my question is, when you give discretion to a sponsor, you're obviously you're surrendering control and losing flexibility. And given kind of the volatility of the public markets on our public equity portfolio, keeping things balanced, right? We lose flexibility there. But I guess my question for you is just based on what you've seen for us and based on what you see for other clients of yours, do you feel like maybe we give up some quality in terms of the sponsors that are willing to accept the SMAs where they're conceding judgment to the capital, right? So what I'm getting at is really good sponsors would be reticent to say, okay, our capital have discretion to sell whenever you need to sell, right? I mean, is it that it's a balancing act? I know we love the flexibility, but do we box ourselves out of some of the best sponsors in, sector specialists by not vectoring more capital to discretionary funds?
I think that's a fantastic question and something that we've looked into fairly extensively over the years. And I think there is a bit of truth to it. And some of that has led to, as we mentioned, kind of a funneling of partners to a core set of strategic partners that ASRS works with that truly are best in class, and we would line them up against really anybody in the business, and have demonstrated true outperformance relative to their peer set, which is part of the analysis that's conducted when underwriting new commitment to these groups and so on. At the same time, real estate is fundamentally different from private equity in that there is no correlation. In fact, academics have observed an inverse correlation between size or scale of the investment manager and the returns that are being generated. In addition, commingled funds, particularly value add and opportunistic funds, again, in academic literature have been demonstrated to underperform certainly their targets, but also levered core strategies. I think the industry is going through a bit of a reckoning as a result of the preponderance of data that's suggesting this. I think ASRS was ahead of the curve in recognizing this and has thereby benefited, getting the liquidity benefits that you describe, and over time really allocating to those partners who are both really best in class in their space, or true operators in their business, and recognize the benefits of having more or less, well, certainly long-term capital through the form of separate accounts relative to having to always raise a fund and the ups and downs that creates for their businesses. I'm sorry, Mr. Pecunis, that was a long answer, but
No,
I hope I got there.
helpful. That was helpful. And I think what I've experienced in my time on the board is that we're not micromanaging the sponsors, and it's more an opportunity to an ultimate veto or trump card, but we're not actively second guessing decisions or creating unnatural liquidity requirements for these operators. I think if that were the case, then you'd you'd end up limiting your
Absolutely.
universe of sponsors who'd be willing to accept that. It's a balancing act, and it's a dynamic that I've been watching since I joined. So
Yeah, Mr. Pecunis, that's such a good point, is that it's really important that everybody understand where they add value
Yeah.
in the process. And I think, in collaboration with ASRS, we add value on the major decisions that actually impact ASRS's portfolio performance. We're not picking paint colors or second guessing, lease decisions and so on
Sure.
that our operators are expert in executing. And I think, again, we've really focused on the groups that have demonstrated meaningful outperformance.
Got it.
I
Thank
could
you.
just add an important point of context. These value add funds that are being recommended are from our operating company partners. So we've invested in 3 different operating companies within the real estate portfolio. So ASRS will benefit from the GP economics and the growth of those firms by launching discretionary vehicles. And as Taylor mentioned, we think they're best in class. And so we're benefiting on both sides of these commitments to add value to the portfolio companies.
So kind of anchor investments, Mike, where we get it's equity value and fund performance that we're getting the benefit of with our commitments.
Exactly. And, other LPs expect that a partner like ASRS would commit LP capital in addition to funding its GP commitment level.
Yeah, the reality is if we're making LP commitments with sponsors that we control, right, that makes it easier, right? So I got it. Thanks.
Indeed.
And I'll just add too, before we move to the next slide, I think real estate is somewhat unique as well in that you can have best in class managers that have commingled fund vehicles, but also operate within a separate account model for strategies that don't directly conflict with that vehicle. And we've seen that with some of the managers as well.
Sure. Thank you.
Okay, page 124, next page, please. Just a quick note to say that we are, while we're, recommitting to existing sponsors, also looking for ASRS in a couple of areas where we feel like there's strategies of interest here in the near term. So one of which is industrial development. Clearly, some certain markets, Southern California, were oversupplied given the disruptions due to COVID first, and then from tariff increases, for instance. But limited development since 2023 really has created an opportunity, a pipeline gap, if you will, as the continued demand drivers for industrial, including reshoring, nearshoring, e-commerce growth, and updated supply chain requirements really do remain relevant. So that's a strategy that we're looking into and thinking about over the next 24 months. And then, as Taylor mentioned, also office really has experienced a major correction given the work from home dynamic. And so on two fronts here, really well located, highly amenitized office is very interesting in certain markets. And another bright spot that we're really following, an area for ASRS to explore, is medical office. Our aging population, increase focus of the population on longevity and health span really requires health-related real estate to support that growth and demand going forward. And then I'll just mention quickly on the monitor strategies at the bottom of this slide here. We've had these strategies on here for a while, and it's something we continue to monitor, but ASRS has not allocated any dollars toward these strategies: manufactured housing, self-storage, low-density housing, and residential land here for this forecast cycle, but something that we're thinking about as we move forward. If you can switch to page 129, please, I'll just wrap up here to say that we really do believe ASRS is well suited to continue exceeding the benchmark, given, as we've said, the projected active portfolio management and focus areas for investment included in the planned allocation, model allocation. So over the next 5 years, to put some numbers on it, we expect a 260 basis point outperformance, really attributed to, the balance of life cycle risk. Taylor mentioned value add opportunities, development opportunities going forward, alongside our favored property types, including, again, residential, industrial, and a continuation of the data center strategy that exists today. So with that, I'll turn it back to Mike and Taylor for any last thoughts or questions.
I would just open it up to questions from members of the board.
Mr. Chair?
Sir, Tom?
Yeah, so sometimes it seems the asset classes might be on the boundary between real estate and private equity, and I specifically have in mind the data centers here. Are they, do we look at them within IMD as a real estate asset or as a private equity investment? I've seen both out there. I was just curious how that's coordinated internally.
Mr. Connolly, I've seen data centers and infrastructure funds as well, right? If that's what you're referring to. But Mike, I'll let you answer the question.
Yeah, I think our specific strategy is real estate because what we're doing is development. So identifying land parcels or office buildings that could be redeveloped, and then going through the entitlement process, the power procurement process, design, development, and then leasing. And I think that data centers it's really the infrastructure rather than private equity. There are private equity funds that we're invested in that are buying data center developers. So the operating company and then going and building out data centers. But because they're buying the company and then building, and then that's a private equity strategy with a higher return.
Yeah, that makes it perfectly clear. Thank you.
Yep.
There's no further questions. We can move to Al. Thanks, Mike. Move to Al.
Thanks, Mike.
Yeah, Al Lemo, Deputy CIO. I'll be talking about our 2026 credit asset class implementation plan, which was approved by an internal committee in January. If you could turn to page 148, please. This is just a quick summary. The two most notable points are that we've lowered our target return for the asset class from 9 to 10% to 8 to 9%. I'll go into more detail on that. And secondly, that in this 2026 implementation plan, we are going to implement 1.6 billion of new commitments to maintain pace with the expected growth in the total fund over the coming years and target a 22% investment allocation that's consistent with the SAA target for the asset class. Going to page 150, which is talk about performance. Most notably in the primarily the 1 and 3 year periods, we've lagged in performance versus our custom benchmark. And we've talked about this multiple times over the past IC meetings, but the benchmark for the majority of that time period was a benchmark comprised of tradable loans plus illiquidity premium of 2.5%, which means that we have to start with achieving at least a 2.5% return. And then on top of it, the performance of the tradable loans, they had a massive rally since 2022, where spreads have come down and they posted outsized returns that we just simply can't. When you factor in the 2.5% illiquidity premium, that's part of our benchmark. We just can't compete with that over that time period. For example, our custom benchmark over the 3 year period was 12.5%. Our target portfolio return was 9 to 10. We weren't set up to achieve that. That is not a long run outlook that could be achieved in the tradable public markets. But over that 3 year period in time, it's something we could not keep up with. And then secondarily, we had returns particularly in the 1 year period. We had a 1 year return on a TWR basis of 5.8%. That's below the historical returns we've achieved in the asset class and below our new target of 8 to 9%. And that's similar to what we've talked about in the prior few IC meetings, is that we have a mature portfolio in credit, and some situations that were invested in many years ago have now resulted in meaningful write-downs of the value of the individual investments in certain distinct partnerships. These are essentially distressed loans that were either originated originally as a performing credit in private debt or within a distressed debt mandate that have now been written down. And the simple answer, why did that happen, aside from specific operating characteristics of the individual investment, specific business outlook, it is, in my mind, all tied to the jump in interest rates starting in 2022. The base rates were 0% in the US and essentially 0 in Europe. They jumped to 5%, and they've come down from there in the past year or two. But nonetheless, that big jump in interest rates led to a substantial pullback in interest in M&A. There's several articles covered in the Financial Times over the past year talking about the roughly about $4 trillion of backlog of private equity deals that need to be sold. And what that's done, and this is just a perception, is that's crowded out interest in M&A for troubled companies. So if you have a troubled situation, the demand for it might be no buyers. There may be one buyer at an unattractive price that forces you to market down. But that's the reality of what's happened in the M&A market in the past 3 to 4 years. I'll stop there to see if any questions on that.
Any questions from anyone else in the committee?
Yes, Mr. Chair, I have one. What you were just talking about, where the funds we own, we've had some residual assets marked down. Do you think this is like a general characteristic of the funds in this area, that you'll accumulate your worst performing assets over time, and then after a period of time, they'll start to mark them down aggressively to reflect economic reality? Do you think it's a general feature, or is it just a characteristic of the circumstances you talked about with the interest rate changes.
In my mind, it's the latter, the circumstance of the specific companies. And let me give you an example. I mentioned in this page 150 about a change in business outlook that was unrelated to the M&A market, somewhat related to the M&A market, but let me explain why. So a distressed debt partnership and a strategy we're not investing in anymore. Back in 2018, in Europe, along with another investment manager, acquired the debt, as is what their strategy, of a company in Germany that makes fasteners for solar panels. And they were able to, when they took control of that business, grow its EBITDA, which is a big determinant of its value, multiples above the time they bought the company. So the substantial expansion in the value of the company, an outsized valuation over time because of the growth in solar panel demand in Germany. But here's where the M&A market came into play. So we were encouraging them along the way, hey, please exit. You know, this investment, you've had a great return, please exit. And for a variety of reasons, some tax related, they postponed that decision. And then 2022 came and interest rates jumped like from 0 to 5%. The M&A market evaporated, specifically for like a monoline business, in a very narrow business. It was the number one maker of fasteners for solar panels in Germany. It's, you know, very limited business, doing really well, but limited business. So they, about a year or two ago, they decided as a way to form an exit, since they couldn't sell the individual company on its own, they decided to merge with another US-based company with a global footprint in these fasteners for solar panels and merge into that company and then ultimately exit, hopefully with a higher realized value from the synergies in that company. Well, what happened is the changes in the tax law this past year, particularly in the US, specifically in the US, which are now exposed to, took away the credit for solar panels. That substantially adversely affected the business outlook, and they had to take a substantial write-down. So it was specific to the company and market and business, but the ability to exit through M&A was adversely affected by what happened into the jump in rates in 22 and the enormous backlog for unsold transactions in the private equity market. And I would refer you to, again, if you want to track what's going on in private credit or M&A markets, I think the Financial Times does great coverage on that.
Yeah, I read that every day, so I'm familiar with.
Yeah, they do a better job
private
than
credit pieces.
a better job than the Wall Street Journal and other people on it. Anyway.
On the dollar weighted portion here, I'm really embarrassed to have to ask this question. I wish I remembered, but so the IRR line is that's net a cost, right? That's a return that's netted out all our costs. And then the MSCI private debt index, is that a gross of fees calculation or a net of fees?
My understanding it's net of fees based on the actual cash flows of the individual partnerships they track.
Okay, so it's directly comparable then? All right.
Moving on to page 100, please. 152, sorry, 152. This is a breakdown of the performance within credit amongst the three sub-asset classes we track or classify. Private debts generate the best returns historically. Other credit has generally had good returns, not as strong as private debt, but distressed debt has been a big disappointment for us. And a lot of that primarily due to the situation I just described to you. We no longer invest in and have not for several years in tradable distressed debt. That's where a distressed debt manager will purchase in the secondary market a loan at a discount and hope to then work it out for a higher recovery value through a restructuring process. And we found that over time, that just has been a disappointing strategy, even though we have not invested in it for several years in terms of new investments in, of tradable distressed. Nonetheless, we have legacy investments that go back pre-COVID that have hurt us. So I just want to point that out. Going on to page 154, please. So we remain positive about the long-term outlook for the credit asset class and believe an 8 to 9% expected return is achievable. That's down from our historical 9 to 10% assumption. And the lower target of 8 to 9 reflects a combination of factors, including the increase in competition for private lending, particularly in the US. The largest private lending market is in the United States, and it's been over the past several years, has been a lot of new players in the market. Some were existing players that have very, very large platforms that have really focused on it as an asset class. And there's just a lot more competition means often less attractive returns. We've also seen a drop in interest rates in the US and Europe, which does affect returns to a degree. And this is most meaningfully the lower expected recovery values for defaulted transactions due to a limited M&A market for troubled companies. So we think 8 to 9 is achievable. Moreover, we're underwriting new partnership opportunities with typical expected returns of 10% or higher. So anything we're doing that's new, and I'll talk about some of the new things we're doing in a minute, all of them have net 10% IRR targets over the course of a several-year investment cycle. But we also have a mature portfolio, unlike a number of other institutional investors. We've been investing in private credit really since 2012. And I think we know that now, particularly over the past 2 years, that inevitably there are going to be some partnerships that disappoint. And we don't know why that might be the case now, but there might be some development over time as things change in the macro or micro environment that lead to some disappointments. So we're factoring that in conceptually. Any questions on that?
I just want to know, since we were kind of pioneers in this space years ago, if I recall. And what would you say are the big I guess Samer talked about this earlier in private equity. What are the big takeaways that we've learned from the beginning till now that we might use to our benefit going forward from our experience in this space?
It's a great question. That's a great, I think one thing we learned is what I pointed out earlier, is that inevitably we're going to have even managers with proven strategies that are going to disappoint over time. There's going to be, our largest partnerships generally have met our return expectations, which is good, but some of the smaller ones, and some larger ones have disappointed recently, but ultimately there's going to be disappointment. I think that's the reality. But it's not only a lesson learned, it's just kind of, it's what you'd expect to happen over time when there's an attractive market opportunity. So if you go back 2012, 2013, we got into private credit, there are very few niche players primarily. Then the returns become proven, become attractive, the market starts growing. Investors are attracted to attractive returns. So they came into the market. And I could cite people like Apollo, Blackstone. They were not major players in direct lending 2012, 2013. They may have been tangentially involved in it, but they were not major players in it. Now they are major players in it. There's other people you could cite along the way and that's just a natural consequence of any asset class that posts attractive returns, that attracts capital. So what we're doing in that is that we have not been allocating new capital in the US middle market, private credit market, which is the largest, call it just backed by private equity sponsors. We've been not allocating new capital to that area, with the exception of differentiated strategies, for example, like private credit CLOs that have more leverage, offer higher return, highly differentiated. Other than that, we've been allocating and diversifying beyond that.
Well, I have to admit, it's somewhat comforting that you actually, in light of your comments about attracting assets in private credit, that the return, you lowered the return expectation a bit. I imagine that's in part recognition, in part of all the capital coming into the space, chasing opportunities. I just have one last question. It seems you mentioned the Financial Times. A lot of the incidents reported in the last 6 months seem, where they're talking about specific credit blowups, seem to be in the asset-backed space, and a breakdown of maybe accounting firms that just aren't verifying collateral and, you know, it's really basic things like that. Is that a systemic issue, or do you think that these are just one-off problems? Is it something that we should worry about in the asset-backed space?
It's a great question. We've talked extensively with our two largest partners in the asset class, and it is not a systemic issue. It is rare that it happens. It's a basic business risk or investment risk that we don't think about so much in the United States as in some other countries, that there might be a fraudulent actor who sponsored a business, and because it doesn't happen that much in the United States, but there have been some notable transactions in the press in asset-backed, and it's rare. It's highly unlikely it's ever going to happen, but it's also hard to prevent.
Yeah, I just wonder if I should short the big four accounting firms or not. So,
You know, it's the auditors. Reality auditors are not set up to detect fraud. They're not. They're set they're designed to detect to provide a fairness opinion on whether financial statements are fairly presented. And I know you know that, but it's very difficult to detect fraud. The problem in those situations in the asset-backed world that have made the press is that there were people verifying collateral, okay, that are specific. They're not big four accounting firms, but they're specific firms that all they do is verify collateral for the best institutions in asset-backed finance, banks, and other players like our partners who did not detect it. And for a variety of reasons. In one situation, okay, the institution that basically created a fraudulent URL, if that's the right term, where the auditor believed it was verifying the collateral with a reputable company. Instead, on the other end, it was a fraudulent player. So that was in the press in one of those situations. That's kind of like a Bernie Madoff type situation. It's just very difficult. But picture these are one-off transactions. They're rare. We don't think it's systemic at all. And just going beyond that, we've also asked our partners to see what enhanced due diligence they can do to help prevent that. So moving on to page 157. So just an update on our investments in credit. Right now we have 21 active strategies. When I say active, meaning they're actively investing, making new investment commitments on behalf of ASRS through a partnership. There's 5 in private debt, U.S. corporate, 4 in real estate and asset-backed. That's up by 2 in the past year. 4 in European credit, that's up by 1. 5 in other credit, and 3 in distressed debt. As of September 30th, we had 14.5 billion of net commitments to the asset class, representing just over 23% of the total fund. Those are that are actively investing capital, and 3/4 of those are allocated to private debt or direct lending partnerships. And over 95% of our active commitments are in partnerships that give ASRS a right to either terminate the investment period early, or as well as maintain an evergreen partnership to keep on investing and grow the partnership over time with the investment manager. Moving on to page 159. So in 2025, we made $1.8 billion of commitments within the credit asset class. 1.4 billion of that was to 5 new partnerships and 1 existing partnership. And the other 400 million of the 1.8 billion, we reallocated a commitment in real estate that was really a direct lending partnership. We reallocated that to credit. And of the new commitments we made essentially a $500 million commitment to an asset-based finance partner. And keeping with Board Member Bakunis's question on the real estate, this was regarding, are you sacrificing anything by requiring, in this case, an early termination right with a manager? This was with a best-in-class partner in asset-based finance. Coincidentally, they are one of the 2 best partners in our view in the sector, and the other one we already had an established partnership with. We created a $400 million new fund-to-one partnership investing in securitizations backed by privately originated residential mortgages. These are mortgages that are not eligible for Fannie, Freddie, or Ginnie Mae. Originated by my colleague, John Trusiak, and his view, this was clearly the best-in-class partner in that asset class. We formed a new fund-to-one partnership with a partner in London for European direct lending. We think they're one of the 2 top managers in the space in Europe. The other top manager we've had a long-standing partnership with. We also added 150 million to an existing partner doing risk-sharing transactions, also known as SRTs. And then we transferred the $400 million from real estate for European real estate lending. And this partner is we think the preeminent real estate lender in Europe. Any questions on that?
I have just one in real estate and then in credit. I noticed, I think there's real estate debt in credit, which you just covered. And then also in our real estate program, wasn't there some credit partnership in that, at least at one point? Do we have a clean view on where?
Yeah, that's a great question. So we did transfer the true direct lending partnership to credit.
Right.
And there may be some legacy old investments in real estate that don't fit in with direct lending, and I'll let Michael speak to that if he has to. But we did internally create a line of demarcation between the 2 strategies, between real estate and credit going forward. Anything that is private, that is preferred equity or equity, would go to real estate. And anything that was direct lending would go to credit.
Yeah, that makes sense. Okay, thank you.
Yes, also there's one partnership that is a legacy fund investment, likely will be liquidated over the next 2 to 3 years. That's credit, buying bonds primarily. And then we have, but the real estate portfolio going forward will be equity strategy, preferred.
Renee, can you hear me? I can't hear them at the meeting, but
Yeah, I can hear you, Jay, or
yeah, so
Mr. Chairman.
I just jumped out. You can call me Jay. I just jumped out and restarted. So I don't know if you guys can hear us, but we can't hear you, the remote participants.
So when you left and came back in, were you able to hear them or still no?
No, I still can't hear them
Oh,
either.
okay.
And they might hear us. I don't know. For the other participants who are on the call, can you hear us?
I can hear you, but couldn't hear the
Yes,
conference.
Okay, great.
correct. I can as well, Jay.
Okay, sounds good. I'll put it in the chat. So for those of us on the phone, I'm guessing they're trying to redial back in. It was Clarissa's feed and it's muted. Cole, if you can hear me, can you try to text some of the folks in the room? I don't have people's cell phones just to let them know that we're having this issue. I can't tell if I'm sure they're figuring it out, but
Can someone online just confirm you can hear us now?
I can hear you.
I can hear you now.
Thank you so much.
Oh, sorry. Let's repeat Mr. Connolly's question. I think he was asking on this page 165, what is included in the definition of what a default is for purposes of this pie chart? And it's the borrower is no longer paying interest. And that answers your question. In the interest of time, I just like to just explain the rationale as to how we came up with the 1.6 billion, as I previously mentioned, of new commitments in 2026. And what we do is we forecast out each individual partnership we have in place. And then based on that forecast of capital deployment, we then compare that to an expected growth of the total fund over the coming 3 years. We've assumed 5%, which is what we've internally decided is the assumed growth rate of the total fund value. And then based on that projection, we determine where we're going to be versus in terms of investment versus the target of the SAA. Our target is 22%, and we'd like to be at that target level. So based on that forecast, we were seeing that over time that we would fall below the 22% based on the existing commitments in 2025. So then we figure out and determine, well, how much in commitments will we need to have to achieve 22% over the course of that time frame? And in this case, and thank you for bringing up the slide, it was 1.6 billion. And that's what we've approved internally and that we're implementing. And so far we have 850 million of that already implemented of the 1.6 billion. So I'll stop there to see if there's any other questions on credit asset class. Not hearing you.
Thank you, Al. Hearing no other questions, we'll move to 4F, preliminary total fund investment performance. It's be page 194. So if you see on the upper left-hand side, this is again preliminary total performance. Market value of the fund is just a little over 64 billion. You'll see at the top line total plan returns, 1 year, 3 year, 5 year, 10 year, 20 year, and since inception, all above the actuarial assumption rates. If you look at the excess return, which is the third row down on the total plan, we have excess returns across all periods except the 3-year time period. So with a negative 68 basis points. One thing I do want to mention that as of yesterday's market close, the market value of the fund is now down to 62.5 billion. And with the S&P down today, it's going to be a little lower tomorrow. So that concludes our formal comments for agenda item 4. Move on to agenda item number 5. Or back to you, Chair Pakunis.
Thank you very much. Sounds good. As you said, let's move on to agenda item number 5, the presentation, discussion, and appropriate actions regarding risk analysis and investment compliance. Mr. Butler.
All right, for the record, Robert Butler, the Investment Risk and Compliance Officer. I have the privilege of speaking to 3 presentations today, so I'm going to go a little quicker than normal, but please stop me if there are any questions along the way. And then I guess, as has been pointed out by other speakers, a lot has happened in the markets since the end of the year, and these slides of the analysis are all based on our portfolio at the end of last year, do not include all the excitement that's happened since then. So I'll start on page 197. You're just showing the highlights of the report. And at least at the end of the year, NVIDIA was our largest stock. I haven't checked to see if that's changed in the last few days. But then I'll go ahead and jump forward to page 202, the correlation matrix. And here I always like to point out that when you're constructing a portfolio, if you have assets that move differently and respond in different manners to shocks, you can create a smoother overall portfolio. And here in the green, you'll see especially interest rate sensitive with the lower correlation to the rest of our portfolio, where previously I would state while we were underweight treasuries, we're still still like the role that they play in the portfolio, adding that diversification. As stated by John, we are close to our target now, but we still benefit from the diversification benefits that treasuries provide to the portfolio. Head to page 203. Again, the chart on the left shows our dollar weighted allocation of assets. On the right, it's the contribution to volatility from those assets. So you'll see the higher contribution from both public and private equities. However, as I always like to point out, this is a much lower contribution from equities than you would see with a 60-40 portfolio, with 60% being from equities, 40% from bonds. And that portfolio, about 99% of the volatility comes from the equity slide. And let's go ahead and jump to page 206. It's our historical stress test. And again, the reminder / disclaimer. This is based on our portfolio at the end of the year, what would have happened hypothetically in these past stress scenarios based on basically factor shocking our portfolio. And I believe this is the second time that I've shown the addition of the 60-40 portfolio for comparison purposes. So previously the gray bars represented the difference in performance between our portfolio and our benchmark. Now those represent a third portfolio, the 60-40 portfolio, which you'll see typically loses less in a crisis due to the heavy allocation to bonds. And then I guess quickly on page 207, here we just zoom in on the contribution to our portfolio from the credit asset class and interest rate sensitive, which is that treasuries allocation. And you can see in most cases, they offer a little upside or very little downside. And comparatively in these stress scenarios, usually the losses from equities contribute about 70 to 100% of the loss. Not meaning they're down 100%, but of the portfolio loss, they're the major contributors. And then let's jump all the way to 213. External managers. And again, the reminder is that we are our own largest manager, primarily in US public equities, as well as a large portion of the treasuries portfolio. But you'll notice the concentration we have with managers primarily in the private credit and real estate space, in addition to our two external public managers. And that's my quick risk presentation, unless there's any questions. Hey.
No questions here.
Moving to
Anything else?
All right, page 216, please. And I guess the reminder is coming up next, we are going to do a deep dive into the private markets investment compliance program. And I'll be joined by people from both Makita and RCLCO. So if I get anything wrong, they can correct me soon. Then we will jump to page 218. Always happy to share that there were no exceptions in the pre-trade compliance that we used via Bloomberg, which is our order management system. And then I'll jump all the way to 222. And we had no major exceptions found in our monthly compliance report, which we get from BNY, our custody bank. The previous time I reported, the time frame in question was from August through October of last year. And since I submitted these slides, I did get the February update. And once again, no major exceptions to report. And then I guess quickly on page 223, you'll hear more about this soon. RCLCO for our real estate separate accounts does a review to make sure calculations are done correctly. They review valuation policies, expense policies to make sure those are in line with our expectations and industry best practices. they'll tell you more soon. And they have completed the 2023 reviews, and the 2024 review process has begun. Stay tuned for details. And then I'll just skip to, got my page numbers wrong, 226. With the reminder that Makita does a similar review of our private investments, mostly private credit and private equity in the fund space. And they have completed the 2020 and the 2021 review, and the 2023 review is in process with, I believe, 10 reviews completed so far. That completes my first compliance presentation.
Thank you. You ready to jump right into agenda item number 6?
Yes, I think I see my my co-conspirators online. So I'm joined by Michael Clyde from RCLCO and Joe Gill from Makita. So I'll just kick us off quickly on page 229, and then I'll be turning it over. So this program was started back in 2015 after the suggestion from our external auditors as a best practice to institute. And Makita may touch on this, but I know timing of these reviews always comes up. I believe Makita got started in 2016 with the mandate to go back to 2014. So in addition to the time lags you have while waiting for audited financial statements and the just general lag and privates reporting, just want to get it out there with the Makita one, we always started with like a further look back. Because I know sometimes it sounds like we're behind, but we're not really behind. And then also just want to remind everyone that this is like an additional layer. I'd say it's beyond double checking, more like a triple, quadruple checking, because all of these investments have been due diligenced by both our internal staff and our external consultant partners. And there's also ongoing monitoring of the investments. And then most of them also have audited financial statements, and then this program kicks in. So it's not, if something like hasn't been reviewed yet on this side, it doesn't mean that it hasn't been looked at, if that makes sense. And with that, I'll turn it over to Michael at RCLCO.
Good afternoon, everyone. Like you said, my name is Michael Clyde. I'm from RCLCO Fund Advisors. If you want to go ahead and jump to a page 232. Oh, I think I'm off one. 233. Sorry about that. So with our review, we take a look at the separately managed accounts. What we kind of go through with them is the audit that we do get. We make sure everything was prepared according to the operating agreement and according to best practices. As he pointed out with the audit, we typically wait for those to come in. Then there's a little bit of lag where if there's any questions or anything, we get the additional backup information. So we finished 2023. We're in the process of 2024 currently. We'll go through the audit, the financial statements. We'll go through the NAV calculation of the hypothetical liquidation, make sure that is in line with what they should be doing and following some of the best practices there as well. And then the deep dive that we'll do is into the fee calculations, asset management, property management, construction, development, anything along those lines that may be involved with the separately managed accounts. We'll also review the valuation policies and the expense policies to make sure that everything is consistent with regulatory standards and with the operating agreement. And then any issues that may arise, we'll work directly with the managers to repair any issues that may come up. The benefits of this being that since we work hand in hand with a lot of these managers, we are kind of consistently reviewing them. We'll get monthly statements, quarterly statements, and then we'll have the year end with the audit where we can kind of compare everything that's going on. So having that ongoing review does help a lot when the year end comes up and making sure everything is in line with the audit. If you want to go ahead to the next page. Just as an example of things that we do find or things that will occasionally come up. We did have one separately managed account where the NAV was overstated in 2023. They actually did not supply us with one. We added, but us running an internal model, we're able to see the variance there, which did overstate the NAV. So we did have that corrected, corrected in 2025. Additionally, the asset management fee on that account was overpaid. We work with the manager to get that corrected as well. The interesting thing about these was both of them were also missed on the audit. Again, us having that close relationship with the managers does come into play a lot here because the audit is as good as the documents it's provided, whereas us with that internal knowledge can kind of catch some things that may slide by. There was another one that was another asset management overpayment on the account. The issue with that was just funds not aligning with the bank and dates being off, which resulted in about a $48,000 overpayment. We worked with the manager there, got their dates corrected going forward, and then working with them to get the overpayment accounted for. And then the last page, or the next page, is just a summary of the amount of SMAs we do, what we're typically looking for, as you stated, the audited financials, the NAV, the asset, the property, any other expenses that may come up, the insurance on the plan to make sure that they are carrying the correct level of insurance, and then any expense evaluation policies. And then with that, if there's any questions, I'd be happy to take those, or we can move on to Makita.
All right, Joe, I think you're up.
Thank you. Hi, everyone. My name is Joe Gill, and I'm with Makita Investment Group. We can start on page 236. So what I'd like to cover in the next over the next few minutes is just to give you a clear picture of how our fee validation work protects ASRS's interests across your private markets portfolio. We'll talk about what we actually do day to day, why it matters, and what kinds of issues we've caught for clients in practice. The service is essentially taking the management fees, the offsets, carried interest, and income allocations that a general partner reports to you, and we're essentially independently verifying that those numbers hold up against what's written in the legal agreements. We can think of it as sort of a second set of eyes to make sure ASRS isn't being overcharged or underallocated. And there's a few places where this can show up. One is management fee rebates and adjustments. When fees shift in a meaningful way from one quarter to the next, mistakes can happen, and we want to understand why that number changed. Capital account rebalancing is another one where we frequently dig into to ensure that the rebalancing is done equitably. We're also looking at timing nuances and structural quirks, especially where there are multiple LP closes and any place where a GP has made assumptions that we think we need to explain or have further explained or justified. So we're not just flagging potential issues in a report and moving on. We're going directly to the general partner, working through the details together and really getting to a resolution. And in some cases, that resolution means money coming back to ASRS. Next slide, please. 237. So one thing I want to emphasize is the range of what we cover, because fee structures in private markets are anything but standardized. We work across every major asset class, and when each of those we see a wide variety of fund structures, which includes, limited partnerships, co-investments, and open-ended vehicles, to name a few. On the carried interest side, we handle, American waterfalls, European waterfalls, and performance fee arrangements, all of which calculate differently, and all of which are, they require meaningful and careful reads of the governing agreements. So management fees are another area where you see a lot of variation. Some funds charge on, committed capital, others on invested capital, some on NAV, and some on invested capital, including leverage. So each basis changes the math. And there's the offset and waiver landscape. All of these can reduce what you owe, but only if they're being applied correctly. So this complexity is exactly why, independent value validations matters. Funds do not look the same, and the details make all the difference. Next slide, please. So I'm going to walk through 5 specific areas we focus on in every engagement. And the first is, obviously the management fee validation. We start by, reading the agreements, pulling out the fee terms, independently recalculating what that gross management fee should be. And if our number doesn't match what the GP is reporting, we go to them and work through the difference until it's resolved. The second is management fee offset validations. So it's the same idea here where, we look at what offsets ASRS is entitled to under the fund terms. We recalculate your share and compare it to what's being applied. So if something doesn't line up, we're following up with the manager. Third is carried interest validation. So this is often the most complex piece where we are rebuilding the preferred return calculation from scratch using historical cash flows, NAVs, recalculating the carry as the GP is reporting it, and then really verifying that it matches the fund's terms. So carry calculations have a lot of moving parts. So a small difference in methodology can really lead to material discrepancies. Fourth is expense allocation analysis. We verify that ASRS's share of fund level expenses and any shared expenses is being calculated correctly. Allocation methodologies can be surprisingly inconsistent, and this is really an area where we've found some real discrepancies before. And finally, we look at the investment valuation adherence. Really, we're reviewing the GP's valuation policy, checking whether they're actually following it, and if something looks off, we're asking the GP to explain or even correct it. So across all 5 of these, the approach is the same. We're reading documents, we're doing the math ourselves, and we're comparing it to the GP's information and closing any gaps that we might see. I'm going to turn next to page 240. So I'd like to cover 2 examples of discrepancies we've found historically. The first example involves Linden Capital Partners 4 within the PE portfolio. So when we reviewed a 2018 statement, we compared the management fees that had been charged against what the LPA actually called for. Our independent calculations show that Linden actually overcharged management fees by approximately $6,000. Now, this doesn't really sound like it's a headline number, but there are 2 things that matter here. First, it was just simply wrong, and the only reason it was caught was because someone sat down with a partnership agreement and did the math independently. So second, once we brought it up to the GP's attention, they acknowledged the error and issued a refund to ASRS to correct it. So we reported this to ASRS in 2 ways, which was an immediate email to make sure that they had real-time awareness, and then a full write-up in our fund review memo. And you can see both our calculation and the GP's original figures side by side here. I'm going to turn now to page 241. So the second example to quickly walk through is Monroe Private Credit Fund A. So ASRS's commitment represented about 99.96% of the total fund. We had expected the expense allocations to land right around that same percentage, but when we compared ASRS's share of specific expense categories to the fund level totals, 2 items had really jumped out. First, accounting and administrative expenses were allocated at just over 100%, and then professional fees were even farther off at 109%. So ASRS was being allocated more than its proportionate share of those costs. So we raised both of these to the general partner, and as a result, Monroe provided a revised ILPA template for the September 2022 quarter that brought those allocations back in line. So these 2 examples are just a good snapshot of the kinds of issues that, they don't just surface on their own. They require someone to look at the details, ask the right questions, and ultimately follow through until it's corrected. So this closes my presentation. So on behalf of Makita, thank you.
Thank you.
All right. Thanks, guys.
Is that everything for this item?
Yes, that was the conclusion. Sorry.
Okay, sounds good. Well, let me just get my bearings here on the agenda. So, again, bear with me. I'm dealing with some international technology challenges here, but give me 1 second and I'll jump into the next item. So I think we are ready to jump into agenda item number 7, which is presentation, discussion, and appropriate action regarding the securities lending program. And it'll be Cole Smith.
Yes, thank you.
Thank you.
I am back. And for the record, my name is Cole Smith, Senior Portfolio Manager here at ASRS. I am also joined today by Mr. Mike McDermott. He is a director in the Securities Finance Division at Bank of New York. So I'll start by giving some high-level overview of securities lending along with some program highlights and statistics. And then I'm going to turn it over to Mike to discuss the securities landscape both pre and post the global financial crisis. So that being said, if we could start at page 245, please. Should I wait till someone's back? Proceed. Okay. Thank you. So let's talk about what securities lending is to start here. So as the slide states, securities lending is a system that matches holders of securities with other market participants that may want to borrow or temporarily rent those securities. So in the case of ASRS, we are the supply to the system. We hold a tremendous amount of publicly traded securities across our portfolios, and we will lend these out to generate extra income for those portfolios. Now, the most common reasons that other market participants may want to borrow securities from us include short selling and market making activities, just to name a couple. There are some other reasons listed there on the slide. Now, to understand a program, I must first distinguish between separately managed accounts and commingled funds. So 90% of securities at ASRS are held within separately managed accounts. 10% are held within commingled funds. So quickly, think of a commingled fund like a mutual fund. We have exposure to the underlying securities, but we do not own them directly, nor do we hold them in custody. Thus, the managers of commingled funds, such as BlackRock or Legal & General, are responsible for lending securities from those portfolios. And for those accounts, we do negotiate custom revenue splits with each manager. And that income is automatically reinvested back into the fund once distributed. So that being said, I will focus the rest of this presentation on the separately managed accounts where we hold 90% of our publicly traded securities. So as opposed to a commingled fund, separately managed account means we do physically own the underlying securities and they are custody at the Bank of New York. Now we have also chosen Bank of New York as our agent lender for our program. Revenue generated in the securities lending program is 90% of that goes back to ASRS and 10% of that is retained by Bank of New York. So if there's no questions at the high level, I will move on to page 246, please. So this page focuses on the collateralization of our loans. So when we lend a security from a portfolio, we can take in two forms of collateral, either cash or securities. A big takeaway from this page I want to focus on is 93% of our securities on loan were collateralized by securities as of year-end 2025. So most often for these types of loans, similar asset types are used as collateral. For example, if we lend an equity from our portfolio, we'll often receive an equity or basket of equities in return as collateral. At the onset of these loans, and these are marked up as well, we do receive over collateralization for the security being delivered to us. So the over collateralization requirement is determined by the type of security we are taking in. Now for the other 7% of securities on loan, these are collateralized by cash. And now what we do with this cash is we reinvest it per cash reinvestment guidelines. We invest this into short-term securities, often treasuries, agencies, repurchase agreements, and other corporate and bank obligations. So one point I want to make here is the securities, whenever we do this reinvestment, the maximum maturity of these securities is 397 days. And in fact, currently our weighted average maturity within our program is about 110 days. So before the GFC, which Mike will touch on in momentarily, we did take in a lot more cash as collateral. But during the GFC, the landscape did change, and we can go over that in subsequent slides. Before we get there, I have one more slide to go over. So if there's no questions here, we can move on to page 247, please. So it's just some basic high-level statistics about the program. So when we consider how much for portfolios are being loaned, we refer to the utilization measure. So as of year-end 2025, just under 14% of our securities across our separately managed accounts were on loan. And this is a total value of just under $4 billion. The slide does break it down between interest rate sensitive or fixed income securities, as well as public equity securities as well. And also here, we focus on the earnings. So in 2025, ASRS earned about $7.6 million from our securities lending program. Public equities earned $5.3 million of that. Interest rate sensitive earned $2.4 million of that. Now, when we add this all up, this equates to about 2 basis points of extra return for separately managed accounts. Now, there's a small but accretive boost to performance. So again, these are high-level details, and I'm happy to answer any questions. But if not, I will turn it to Minister McDermott here now to go over the GFC and how that changed securities lending. Take it away, Mike.
Thanks, Cole. Hi, my name's Mike McDermott, and I represent Securities Finance at the Bank of New York, and it's great to speak with you today. With respect to the GFC, really the catalyst or the biggest issue that impacted the securities lending markets was really the downfall of Lehman and the subsequent really liquidity squeeze that took place at and through that event. At the time, from a cash collateral reinvestment perspective, the norm relative to the industry was maximum tenors of 3 years. So 3-year on floating rate securities and 3-year weighted average life from an ABS perspective. Certainly, what agents were investing in from a cash collateral perspective did range. You did have some lending agents that were investing in dealer paper. You did have some lending agents investing in some prime mortgage, others didn't. Ultimately, when the GFC happened and we saw that lack of liquidity in the marketplace and the plummet in on-loan values based on what the capital markets were doing, there were issues on the cash collateral reinvestment side where securities were undervalued. And subsequently, there were some forced sales and some defaults that happened during that time. I think more broadly, the event was a wake-up call for the whole industry. It was a circumstance where these types of investments on this part of the yield curve were historically benign until they weren't, until this Six Sigma event that occurred. The response from an industry perspective was common across many of the lending agents. First and foremost, lending agents reined in their cash collateral reinvestment guidelines. In most instances, they reined into a 2a7 like money market type guideline, so 397 days in. We also saw certainly programs that were operating commingled pools where we had clients investing in those pools. Those pools were unitized structures. Agents deferred to separate accounts. That way, there was no really issue about who gets in or who gets out at what share price. And it also gave clients the ability to customize their guidelines based on their risk parameters. Certainly, we also saw the regulators react quite materially to the event. We saw certainly much more transparency demanded by the regulators for shadow banking exercises like securities lending and repo. Certainly, we saw other regulatory changes like the net stable funding ratio, the liquidity coverage ratio imposed on the brokers. We also saw really a massive deleveraging from a securities lending perspective on the broker side. So all the deleveraging that happened relative to the marketplace, the brokers were also desperately trying to shrink balance sheet. So as a result, we did see a reduction in loans collateralized against cash over time, in more loans collateralized by non-cash collateral, because cash collateral has a balance sheet impact to the borrowers and non-cash collateral does not. Can we go to the next slide? Again, durations were shortened and a lot of attention by the regulators. The next slide, please. So if we look at how BNY Mellon at the time reacted relative to the crisis, we took a number of measures. Similarly to the industry, we reined in guidelines. So our collateral pools that had 3-year tenors were reined in to 13 months and adopted 2a7 like guidelines. We also offered overnight only guidelines and pools to clients as a result of the crisis. If folks on the call remember, the SEC actually reined in 2a7 again in May of 2010, and we'd followed suit and brought in guidelines again in the spring of that year. We also deferred to separate accounts. So we got rid of collateral pools and managed all separate accounts for our clients, specifically tailored to their individual guidelines. We also enhanced our credit process. So leading up to and through the GFC, we had 6 credit analysts dedicated to underwriting the issuers that we could buy with our clients' cash collateral. And we enhanced that capability and basically utilized our asset management capability to a greater extent. So we now share a credit utility with Dreyfus with 12 analysts. So we really beefed up our credit underwriting utility relative to the issuers that we are allowed to buy with our clients' cash collateral. We also added an additional top-down review. Again, enhance the bottom-up fundamental credit analysis of the issuers, but we implemented an additional risk overlay called enterprise market risk. And the way to think about that is they look at really the forest instead of the trees. So they're monitoring program-wide exposures to issuers, sectors, sovereigns, to make sure nothing gets outsized relative to the book. As part of this process, we also migrated to a more sophisticated trading and compliance system. So since the GFC, we moved to Charles River for that system, and then again, more recently to BlackRock Aladdin. So again, a lot more capability from a trading and compliance system where our clients' guidelines are hard-coded into the system for compliance at point of entry. We also moved to daily transparency from a cash collateral reinvestment reporting perspective. So prior and through the crisis, we had a monthly reporting on the cash collateral reinvestment activity. So a monthly NAV, monthly holdings, monthly mark to market. We moved that to daily, again, in an effort to give our clients more transparency from a cash collateral reinvestment perspective. We also implemented stress testing of the portfolios. So our enterprise market risk group, that top-down group, has the ability to take portfolios and really turn the dials in 3 ways: cash flows, credit spreads, and changes in interest rates. And they shock the portfolios to determine what it would take to break the proverbial dollar, to break the 0.995 from an NAV perspective. Our portfolio managers also have that capability on their desktop, where the portfolio managers can individually shock their portfolios to determine how sensitive they are to cash flows, interest rates, and credit spreads. So why don't I stop there? Can I answer any questions for you?
None here. I don't know if questions from other members of the committee? I think you can continue, please.
That's what I had prepared. If there are no questions, I'll close. Certainly, thank you for the relationship. We greatly appreciate it.
Thank you so
Mike.
much.
So if no other further questions, that will conclude our presentation on securities lending.
Okay.
Thank you.
Great. Thank you very much. Okay, let's move on to item number 8. A presentation, discussion, and appropriate action regarding private market benchmarks, including asset performance benchmarks and opportunity cost benchmarks. Mr. Viteri, please.
Thank you very much, Chair Petkunas. Just to level set here, this agenda item was a result of one of our VIP board members coming back, recalling that at the time when he was serving, private equity composite was rolled into total equity. And since his return, private equity now has as standalone. So he's wanting to understand the rationale behind it. At the time, private equity was rolled up into total equity. It was really to reflect a strategic intent to evaluate private equity relative to public equity and determine whether there was a sound opportunity cost decision. So on page 252, just kind of going back on the history of private equity. So we started investing in private equity in January 1st, 2007, 5% allocation measured against the Russell 2000, so a public equity benchmark with a 1/4 lag. In November 2009 and April 2015, private equity was increased to 7% and then subsequently to 8%, still maintaining the same benchmark, Russell 2000, which is a US small cap benchmark with a 1/4 lag. In July 1st, 2018, the strategic asset allocation remained this, increased to 10%, so from 8% up to 10%. And the benchmark changed from the Russell 2000 1/4 lag to the MSCI ACWI IMI net USA gross with a 1/4 lag. So the allocation increased, the benchmark changed, and at that time, private equity performance was consolidated into total equity. So again, for the reasons I indicated earlier, the strategic intent to evaluate private equity relative to public equity and determine the opportunity cost decisions when allocating to those two asset classes. In October 1st, 2022, we maintained a 10% allocation to the same benchmark, MSCI, ACWI IMI, and we actually separated private equity from total equity, once again measured. This was my objective at the time. I wanted to have private equity as a standalone so we can compare. This is really unusual, I'd say, compared to our public pension plan peers. Not many rolled it up. Some had factor strategies, but it was easier to compare how we were doing in private equity relative to others and relative to the benchmarks at the time. And we knew at that time that private equity is performing really well. And we had discussed amongst ourselves at some point in time during the next SAAP, we'd probably like to see an increase in private equity. So that was the thoughts back then in 2022. 2024, we had our Chair Pecunis had, we asked for, or we all agreed on having a secondary benchmark to our private markets. This would be for private equity and for credit at the time. Because a lot of discussions were happening almost on a quarterly basis in that we had a public market equivalent relative to private markets. And typically when those public markets were rallying, our asset classes weren't doing too well, our performance wasn't doing too well. Subsequent times when public market equivalents were not performing very well, we looked like heroes. So it was just talking about that and explaining that almost on a quarterly basis. So given that these benchmarks came out, the idea was that it would be appropriate to have it as a secondary benchmark. So to really get a sense as to what was happening relative to our peers and relative to a good peer-based benchmark. And then July 2025, we changed the overall asset allocation, increased private equity target to 13%, and we adopted the private market-based benchmarks as the formal primary benchmark. So that's kind of the history there. I forgot to mention that on the fourth bullet point on the opportunity cost decision, Samer is going to be kind of covering that 3 pages hence. We're going to be covering kind of the rationale we had and the ideas on private equity and how it's represented. It merits as being a standalone asset class. Go to page 253, please. We kind of covered this when we made the recommendation to increase private equity to 13% and then change the benchmarks. But again, these are at a high level. These are kind of the rules of qualities of a good benchmark that came out years ago. They should be appropriate, measurable, unambiguous, reflective, and investable. So for instance, if we have a benchmark of the S&P 500, we're managing those assets, we should be able to reflect what's happening in the index, and that's what's happening. In the case of real estate, I'm just going to pick on real estate right now. NYCREIF, the National Council of Real Estate Investment Fiduciaries, we compare ourselves to a peer-based benchmark, but we can't replicate it very well. We can't hold the Rockefeller Center in New York as a piece of our portfolio. So it's a peer-based benchmark, and that's what happens with peer-based benchmarks. You're not holding everything, but it's a good representation of what's happening. Page 254. So again, public market benchmarks. We've gone through various discussions as to why those aren't necessarily the most appropriate for private markets. and a couple of them being valuation timing issues. Quarter lag public market benchmark have limitations, but recently with the arrival of more peer-based, more robust peer-based benchmarks, such as the ones we're using right now, the MSCI Private Equity North America and Western Europe for private equity, and then a similar one for credit. You get a direct peer comparison against similar investment strategies, more accurate representation of timing and structural characteristics, quarter lag that aligns with the benchmark, and comprehensive coverage of geographic reasons. So just overall, a better benchmark for our private markets. We end up going to page 255. We'll go ahead and hand it over to Sam, please.
For the record again, my name is Samer Qatar. I would be presenting on page 255. Just to go back to 2018, private equity was part of total public equity with a variable target, which is not to exceed 20% of total equity, which is gives flexibility, but not really benchmarking in terms of contribution to total returns, because you cannot decompose the contribution because it's a moving target rather than a set target. So the intuition behind having the 10% is just to fix it and see, are we overweight, underweight, and how much are we contributing, and so on and so forth. When it comes to private equity have multiple layers why we need to have a higher underwriting than public equity. And I want to give an example that the chief economist of Apollo came up with 6 months ago. He put a slide that was widely distributed, that is there a single name stock for the last 15 years that did more than 20% per annum? In the US, the S&P 500 was one stock. I'm not sure how much this still applies. It was Microsoft. So the long story short is single names, even in public markets, cannot achieve 20% because of the efficiency level. However, in private equity, that 20% is achievable because the opportunity lies in the investment period of a private investor. If they can add value, what we call it is here risk premium, meaning operational efficiency, value creation, roll-up strategy, increasing growth, increasing EBITDA, increasing markets, new product, and so on, and controlling the board rather than having a public company that there's very rarely there's a control of the board. So the risk premium, you can see it in your face, how much should that be? In our underwriting, and then we'll go to in the next slide, we try to underwrite at least 400 basis points over and above the public markets. Historically, this is because we had an amazing run in public equity, which is the last 3 years. We had 25, 23, 25, and then 15. That makes the comparison difficult, but the target's still the same, meaning if public equity is measured by the MSCI All Country Index is at 8%, we should be at 12. I'm pretty sure we should be higher, but the 400 basis points is the least to allow comparison by the commitment of the locking in capital for a longer period of time. And for that reason, I will move to slide number 256. That would be, yes, this one, the table. This performance is not calculated by us, it's by the system, and this system is reconciled by Evan, who's present here. This comes from eFront, Aladdin system, and it shows the cash flows of our private equity if they were invested, as I mentioned earlier in my presentation, in public markets. And if we take two comparisons, which is as Mike presented, when we started investing in private equity, the Russell 2000 was the benchmark, then we moved to ACWI, so we have a blend of both benchmarks, and we are on inception to date, we're outperforming by around 100 basis points, slightly less. But if we compare ourselves historically to MSCI, US growth, because we are a non-tax paying entity in the US and not internationally because we pay taxes internationally, we are outperforming by 200 basis points. That is inclusive of on the outperformance that you see in the 1 year, 2 year, and 3 years because of the amazing rally in public markets the last 3 years. If we go to the slide up, which is 257, and that's graphically how it is presented. This is our portfolio in blue, and the benchmark, which is MSCI ACWI in purple. And we are to put things in numbers. If we invested the same cash flows exactly, in public markets, our portfolio would be shy of 6 billion. Currently, our portfolio is at 8 billion plus. So that's the value add in dollar terms measured by the public market equivalent. And I will stop here to take any questions.
I just have a comment for the future, not to maybe for now, but it seems to me that all our discussions about benchmarks are coming from the perspective of an unasked question. You know, we can use different benchmarks to answer different questions, and sometimes I think we're trying to answer 2 or 3 questions at once with the same benchmark. So if the use here of ACWI, IMI, helps us look at the question of from an opportunity cost perspective, was this a good idea, and might it still be a good idea? The question about using, or the process using the private market benchmark, whether it's credit or equity, is answering the question of how well is our process, how effective is our process in choosing options in there. So I think just having clarity on what questions we want to answer, and it's okay to use different benchmarks to answer those questions. You know, that might be a fun discussion to have someday. What is it we actually want to take a look at and focus on as a committee, rather than trying to combine different questions into having one benchmark answer them all.
Mr. Chair, if I may, Chairman Petkunis, if I may respond, I think that's fantastic. Typically, the way we conceptualize it is really there's 3 benchmarks. And the first benchmark is you think about opportunity cost. Did we, when we did our strategic asset allocation, make an appropriate decision after the fact? That's number 1. Number 2, did we implement it? And that's like a staff ownership thing. Did we implement it well? And everything from the picking the sectors to be into the GPs and so forth. So that's implementation. And then there's a third one. And this is where Samers and his colleagues are experts. And that is, did the GPs individually perform well? And that you look at the individual GP as far as vintages, sectors, capitalization, if you will, where they are on the buyout, small, medium, large. We went through geography and so forth. So you could have 2 GPs that maybe had different rates of return, similar rates of return, and you would actually say one did relative to what the mandate was actually better than the other. So I think from my perspective, I think of it as CUSIP level, if you will, which is GP. That's, I'm going to call that a CUSIP level decision, GP. Then it's going to be a asset class implementation, and then it's going to be stepping away to asset allocation. Have we strategically aligned our investments? So 3 really different questions. Thank you.
Can we reflect those in the investment committee meetings at some point in the future?
Yeah, I think we have talked about it, and we still, in my opinion, lack clarity on that. I'm going to call it trifurcation. So Mike, will you take ownership of that? Thank you.
I think it's there in different pieces.
Yeah, absolutely.
But
I think one area is we're not clear enough about what the question is that we're addressing with a particular answer. And if I'm going to start out with a trifurcation model, and then if you want to permutate that, let me know. But that's where we're going to start. Thank you.
Yeah, perhaps also with the different asset classes, there may be 2 questions, or with another one there might be 4, but so it doesn't necessarily have to be 3 for all of them. Yeah.
If I just may add one point, and I would recommend that to Mike, maybe in one session, we'll show how we underwrite and to show you exactly how we look at the public market equivalent on a CUSIP level, as Paul mentioned. it would be really interesting because we look at the MSCI, then we take it to the Russell 2000, then we take it to the Russell 2000 sector, and so on and so forth, and we calculate the PME, and then we do something even more than that by calculating we call it private market equivalent. So we take the MSCI Burgess, which is a private, and deploy the same cash flows, and to see, is this manager outperforming the universe they are specifically investing in? And then after passing all these layers, we'll take it to the consultants and then to the company.
Well, that sounds wonderful. I've never seen any of that, so that's good.
I'm more than happy to share them. We'll just highlight the name of the manager and we can share them.
Thank you.
Great, thank you. Any more questions?
Thank you very much.
Thank you. Okay, we can move on to item number 9, which is the presentation, discussion, and appropriate action regarding a draft revision to the investment compensation program plan. Mr. Mattson.
Thank you. I'm going to go through sort of 4 thematic items with respect to this presentation. And the first is why we're here. The second, why we're presenting the documentation. The second is the steps we're going to go through before we ask the board to adopt the documentation. 3 is the logic, and then 4 is the themes of the changes in the documentation. So 4 different parts to this presentation. The first is why. We've got an incentive compensation plan document and process that is relatively old now. It is an appropriate time to make a review. Number 2, we've had some changes in benchmarks and changes in very related to what we just talked about, whether or not we're looking and measuring sort of CUSIP level versus asset allocation versus opportunity cost and so forth. 2, we want, and in part of that, we want to align timeframes and investment calculation methodologies. And number 3, we live in a competitive landscape that deserves to be reviewed periodically. So why are we here presenting this? Number 1, it's standard to review historical documentation to make sure it's still appropriate. Number 2, we've made changes to the portfolio benchmarking system. And number 3, there's a competitive landscape that we are all aware of. Now, what steps are we going to go through? There's 8 steps that I plan to go through. Number 1, there was a staff review. That's already occurred. So myself and Mike and some other colleagues have reviewed the current incentive compensation plan. Number 2, we sought input from NEPC, the external party that's responsible to the board, to get their inputs. Number 3, we did comparative data analysis of other funds. Number 4 is here. We're taking it and presenting it to the investment committee so they're aware of what we're doing and why and what the steps we're going through, and we're seeking input. So we're certainly looking for input now, or it can be over the next several days or weeks, should a committee member want more time to think around this. Number 5, step 5 is to go to Department of Administration for consultation. And that is based on the statutory authorization for this plan. The statutory authorization is 38-611. That requires consultation with the director of the Department of Administration. Number 6, thereafter that dialogue or consultation with the Department of Administration, there will be another staff review, fundamentally Mike Pateri, Chief Investment Officer, and myself. Number 7, the director, meaning myself, will likely meet with the investment committee chair and the board chair to say, look, this is what we initially thought. This is the feedback we received from the investment committee. This is the feedback from the Department of Administration. This is what the staff opinion is of how we should proceed. After taking that input, I then plan to bring the final documentation back to the full board. So those are the 8 steps I plan to go through to update this incentive compensation package. Now, what is the logic of having incentive compensation plan? Really, there's 3 things we're trying to achieve. Number 1, to retain high caliber and qualified staff. We want to retain those folks there. They've got a combination of everything from qualitative approach, quantitative skill sets, and things that are hard to measure, but I'm highly confident in highly ethical staff. When you have that aggregate body of individuals, you want to retain them. Number 2, we want to be able to attract new people when needed. And then number 3, we want to align the performance of the total fund and the individual sectors or asset classes or portfolios that people are responsible for. So we want to retain people, we want to attract people should we need to, and we want to align decision-making. That's why we have the incentive compensation plan. Now, what are the changes that we're suggesting for the incentive compensation plan? There are essentially 6 thematic changes. Number 1, we're suggesting we consider increasing from 30% to 60% the incentive compensation based on base pay. So from 30 to 60% increase. 2, change the categorization such that total fund and qualitative factors are increased from 25% of that weight to 30%. 3, maintain the same incentive compensation percentages for each level of staff. That's sort of different than sometimes other organizations, including public pension plans and public sector. And we had a significant dialogue going back and forth. Should it be, for instance, the same percentage to all levels of staff? Or what is common in some organizations, the higher the higher you go in an organization, the higher the percentage of compensation that can be achieved. We ended up recommending that it be constant through all levels of staff. Number 4, to align the periods of measurement from sometimes 1 and 3 and sometimes 1 and 5 to 1 and 5 years across all performance measurement classes. So everything would be measured 1 and 5 years. Number 5, migrate everything to a time-weighted rate of return. So we're not measuring sometimes internal rates of return and sometimes time-weighted return. This was maybe not doable initially because when you have private asset classes, if you do time-weighted rates of return, your initial first period rate of return could be like negative 80% on a penny, right? Highly negative rate of return on management fees. If you then isolate that as a period of time without weighting it, and you link that, it has a highly detrimental rate of return result, even though the money that is being made is being built on later periods. So your internal rate of return would be much higher. So now is the time you can do that. We've got mature private portfolios. And then finally, the benchmarks plus the alpha changes would result in a total fund outperformance expectation reduction from 40 basis points or 0.4% to 35 basis points, which is 0.35%. So those are the thematic reasons why, or thematic changes to the incentive compensation plan. Now staff is certainly open for input, comments, feedback.
Paul, thank you for that. We had a conversation about this, and I'm supportive of the plan change, and I've gone through the memo and we had a conversation. I don't have any further questions or clarifications or even suggestions for improvement, but I'll open it to the rest of the committee to see if they do.
And then one follow-up, this is not the last opportunity that any committee member has to give input. Between now and the board meeting that this gets brought to, I'm certainly open for any committee member to give feedback.
Sounds good.
The incentive comp range from 30 to 60, can you give me some color around, a little bit more color around that, what it might look like in an individual situation and from a peer group perspective?
Yeah, table 1 is probably the best example. So if we go to the cover memo and then it's table 1, which is the second page, I believe that is page 262 out of 304. Is that correct? So 264, if we go down to table 1, those are the results from the Aon McLagan report based on a separation between under and over $60 billion. And if you look down under the 50th percentile, that's probably the most informative. Under the 50th percentile, you see that for the investment staff with under $60 billion, it ranges between 30 and 65%. With over 60 billion, it ranges from 50 to 80%. What's important though, is in addition to that, I should say, is if you go to now the last page, which is called Appendix A, I believe it's page 266 of 304. This is really important to me. 4 things that we try and do at this agency, and we focus on them. And everything else, or virtually everything else, is a process. But these 4 things I'm going to mention are not process, they're outcomes. The outcomes are we want to be extremely low cost. The administrative apparatus and the entire agency, we want to be low cost. 2, we want to have excellent customer service along the array of customer service. 3, we want to have high rates of return, net rates of return after all fees compared to peers and in absolute terms. And 4, we want security, which means data security, personal security, PII, personally identifiable, HII, health and personally identifiable health information. We want security of data, money, and people. So those are the 4 things: excellent customer service, low cost, high rates of return, and safety. Safety of people, money, and data. Everything else is geared to get us there. Now, this table, Appendix A, shows us how we have partially got there using one metric. So Arizona State Retirement System is highlighted in yellow, and the key number is the assets under management per staff, and that's the second from the right-hand side. We have assets under management per staff in one of the highest numbers, meaning billions of dollars per staff member. That's one of the highest numbers. What's more important is, or equally important, is that does not take into account that we, of the 4 funds above us, we are the only one that internally manages funds out of those group. So even taking out the fact that we internally manage money, we have one of the highest staff utilizations per assets under management, one of the lowest number of staff per assets of management. If you then superimpose that we do internal investment management for approximately 1/3 of the portfolio, which in my mind leads to significantly better outcomes, this yellow bar, 5th row down, would become significantly higher. So staff utilization is extremely effective and efficient at the state retirement system. Thank you.
Any other questions? Okay.
Oh, sorry, Mr. Chairman.
Oh, all right, Renee?
And I apologize. I got back halfway into the presentation. I was just kind of curious if Mike Viteri provided any comments, or if not, I guess I would just, I think Ray, because this affects, his area in particular as well, to see if he had any additional comments he wanted to share with the group regarding the proposal.
Chair Petkunas, Mr. Guillen, thank you very much. No additional comments. I think Paul pretty much hit it all. The memo does a good job of covering the rationale behind all the changes in the ICP.
Perfect.
Thank you very much. Thank you very much for asking, and thank you for your consideration.
Thank you, and thank you, Mr. Chairman.
Okay, thank you. With that, we'll move on to item number 11. I'm sorry, item number 10, summary of current events.
Chairperson Petkunas, this is an action item. Number 9.
I'm sorry. Yeah, valid. Good point. Is there a motion? Do I hear a motion?
Mr. Chair, I move to approve that the ASRS director arranged to consult with the Arizona Department of Administration on the incentive compensation plan as discussed, and to then bring a revised incentive compensation plan to the board for final consideration.
We have a motion. Do I hear a second?
Mr. Chairman, I second.
Thank you.
Hearing a motion by Tom Connolly and a second by Renee Guillen, I will take a roll call vote for the motion regarding ICP as stated. Please answer aye or nay when I call your name. Mr. J. Petkunas,
Aye.
Mr. Tom Connolly, and Mr. Renee Guillen.
Aye.
Chairperson Petkunas, the vote has been taken.
Thank you. Now I'll learn from my mistake before I move to item number 10. Anything else related to item number 9?
No, thank you.
All right, thank you very much. Okay, item number 10, summary of current events.
Quick summary, the staff does not have any additional information to provide. Thank you. But certainly open for questions.
Okay. Any questions? Hearing none, we'll move to item number 11, a call to the public. Is there anyone that would like to speak?
No.
Okay. Moving to item number 12, board members or executive director requests for future agenda items. I have none, but Mr. Connolly, you had mentioned a topic that you may want to agendize for a future meeting.
Yeah, whatever was picked up during the meeting as a additional item is fine. I think we're set there. I think everyone picked up on it.
Okay, thank
I don't
you.
remember what it was.
Is staff comfortable that they've captured Mr. Connolly's request?
Yes, thank you.
Thank you. Okay, item number 13, the next ARS Investment Committee meeting is scheduled for June 25th at 9:30. Any conflicts from committee members? Okay. Last item, we will adjourn this investment committee meeting. Thanks, everybody, for your time.
Thank you.
Thank you.
Thank you.
Thank you, everyone, for attending. The time is 12:28.
Bye.